Hello, everybody. I'm John Young from Kingsley Napley. Welcome to the second of our podcasts with KRD, the accounting firm out of Chicago. I'm delighted to be joined by Jamie and Michael for another video. Today, we're going to discuss some of the ongoing tax issues that you might want to consider if you're looking at investing in the US, starting trading there. Michael, as he explained in the last video, is an expert in international tax, and Jamie has a focus on the really interesting issues, at least to me, but state taxes in the US, and I will very much be able to help you out of these things that you need to understand in the course of investments you're looking to make. Michael and Jamie, welcome back. It's great to have you here again.
Thanks for having us.
It's glad to be back.
Okay, so Jamie, I think the first thing that we have on our list to discuss was, once you are actually trading in the US, what are the kind of key state tax issues that you might just need to keep in mind?
Right. So again, it's the fact that there are many different types of taxes that are not only administered at the state level, but also at the local level. And this can be anywhere from your corporate income tax to a gross receipts tax to a franchise tax, as well as various other tax types that include property taxes that would extend to real and or personal property, payroll taxes if you have a workforce, unclaimed property. So, each state has quite a wide variety of taxes to be aware of. And again, not only state, but at the local level as well. So it can be difficult to keep up with the localities because they're kind of behind the scenes, but they can also create as much exposure as the state level. And then another kind of important consideration is particularly for a foreign entity is that if they are operating in the foreign environment but they are here, so depending on how the transactions are structured, certain protections that are afforded under the corporate income tax, such as Public Law 86-272, those protections do not extend to foreign transactions in every state. So there's only like 28 states that actually do allow those protections to extend. So that means that a little bit more than half, but that means the other half do not extend those protections to foreign transactions. So a couple considerations when you're dealing with foreign transactions for United States entities and states.
That protections thing sounds interesting. What kind of thing are we talking about? Is it like double tax protections or?
Well, basically what this means is that Public Law 86-272 is a protection that is supposed to preserve interstate commerce, and it is to enable items to be sold across state lines where if they meet certain criteria, it's only tangible personal property. It's the order is received in one state and then shipped from another, and basically what it does is it provides a protection of the corporate income tax. And again, that is just that transaction has to be really more interstate. And so if there's a foreign component to that, then that protection, that law, that federal law may not extend to that foreign transaction.
So it would be something like if you ordered a car through a website which was based in, say, California, but the car was shipped from Texas, you would only have, as the business, you would only have to pay tax on that transaction in one jurisdiction, state jurisdiction.
Correct.
But if it was ordered from a website in Texas and shipped from, say, Mexico, then you might have two bites of tax because you don't have that protection.
That's correct.
Okay, interesting. So again, it sounds like that's where the US blocker corporations Michael recommended in our last podcast might be quite useful for people.
Absolutely.
Correct.
And so when you are looking at which states you have to pay tax in, how can you work that out? In what circumstances might you find yourself having to pay tax in the state? Because presumably it's not just the state where you're incorporated.
Right. So that's where state nexus comes into play. So basically, state nexus can take different shapes and forms. It used to be whether or not you had a physical presence, and I'll let Michael talk to that for a minute as well. But since we have had some developments in the state tax arena with several court cases that have come up recently, particularly a Wayfair case that basically abolished the physical presence standard and established more of an economic nexus. So, in essence, with economic nexus, you can have nexus within a state simply by having a certain volume of sales. And each state is also different as far as their threshold and what volume would create nexus from an economic nexus standpoint. So in essence, you really do not have to have any sort of physical presence in order to have nexus and therefore a tax filing obligation in a particular state.
So it sounds like if you are kind of shipping goods and you do one or two mail order shippings to a state, you're probably not going to have a problem. But if it starts to become a substantial part of your business, it's something you should really be thinking about.
Well, John, it really depends because when you refer to sales and use tax, the majority of states have $100,000 threshold for economic nexus. So effectively, if you have $100,000 worth of sales into a particular state, you could have sales tax nexus. So you may be obligated to collect sales tax and file sales tax returns. Corporate income tax is a little bit, their economic nexus is a little bit different, and usually the factor-based nexus threshold is around 500,000, but that doesn't apply to all states. So it really depends on the tax type as to whether or not you've triggered economic nexus in a filing obligation.
So it is very much just de minimis little bits and pieces that may happen in the course of another business, but anything where you're actually looking at trading into a state, you're definitely going to need to be thinking about it at a very early stage, because you can see how individual items might just exceed that. I mean, there are plenty of cars, for example, that are over $100,000, or bits of machinery, or even potentially software on large license deployments could be more than that. So yeah, really potentially very significant. So Michael, I think James said you were going to say something a little bit about physical presence and how that can make a difference.
Sure. So historically, physical presence was required in order to trigger nexus. That is in states and in various countries. Now, with the workforces becoming remote and global, and online trade being far more common than a salesman going door to door, jurisdictions are catching up, right? They're catching up to the activity after years of lagging behind. And states, especially in the US, states are taxing more aggressively with these economic nexus standards. So while 30-year-old income tax treaties still exist between countries such as the US and the UK that would protect a UK company from being exposed to a US federal income tax under the treaty unless they met a permanent establishment threshold, which can be seriously high. The states in the US do not have to respect those income tax treaties because those are signed between the federal US government and another country. The states don't have to respect those. So if you're selling into the US and you feel comfortable that you have a good treaty claim, that you don't have a US tax presence because you don't have a permanent establishment and have a physical place in the United States, you may still be subject to US state income taxes and US sales taxes.
Oh, that's really interesting, because I don't think that would occur to a lot of people, that they might be subject to local tax but not national tax. So definitely something for people to bear in mind. And what about state sales taxes? Is there any particular risks around state sales taxes? They're obviously different from our VAT, simpler to calculate, I think. But what should people be aware of as to how they work?
Well, they are difficult to calculate because there's not only a state component, but there's also a local component to many states. And that local component can actually be made up of the city and county and a special jurisdiction. So it's not just a flat state rate that you're really trying to calculate, and that's what makes it so cumbersome and why there is a need for some type of calculation software to help facilitate transactions in the calculation of the true sales tax rate. Also because oftentimes localities will change their rates frequently. So the change in those rates also make it difficult to keep up with. So when you think about sales tax in general, sales tax, it's also different products are subject to tax. There are certain exemptions. So each state really has their own rules and regulations with regards to certain types of products. I mean, you mentioned a software and software licenses. There's a lot of variation in how states tax software. Whether it be software as a service or canned software or software that's been delivered electronically. So there's a lot of variations in the types of and how products are defined and then taxed at the state level for sales tax.
I hadn't appreciated it was that complicated, actually. Whenever I come to the US, like a lot of English people, we find it slightly inexplicable that the prices in the shops are all plus tax, whereas in the UK everything is inclusive of VAT. But maybe the reason for that is it's just too hard to work out the tax and actually show people the real price difference.
Could be, yes.
And how, in terms of who pays the tax, again, in the UK, the taxpayer on a sales tax or VAT, it would be the VAT person, so the company which is making the sale, and that would pretty much be that. Absent fraud, it's the company's problem, not the shareholders or directors. But I think you mentioned to me before that can be a little bit different in the US.
Exactly. Yes, it's very different because the tax is paid by the end user. So oftentimes you may have a complex transaction where you have a person who purchased from a distributor, and they're defined as a reseller because they intend to resell that to the end user. Ultimately, the tax will come from the end user, and the end user is responsible for paying the tax. However, the sales tax is due even if the responsible party does not collect the tax. So effectively, the liability and the responsibility falls on the seller to collect the tax and to pay the tax. The tax is due on when the sale is made.
Okay, and what happens if the seller doesn't pay the tax? I think you mentioned that in certain circumstances, individuals involved could have personal liability.
Well, personal liability usually extends to the point where if the seller collected the tax but failed to remit it, then they can be held personally liable for that, the
Yeah.
responsible person. And that responsible person can be really anybody in the company. It could be the AP clerk, it could be the staff, it could be, it doesn't necessarily mean it's going to be the president or an officer. It could really be anybody in the organization that is deemed to be a responsible person. So that personal liability could extend to them for any sales tax that was collected but not remitted, because effectively it's a trust for the state. So you're collecting the tax as a trust and then remitting it to the state.
That's really interesting. I would be quite scared of that job, I think, because with the best will in the world, if something goes wrong in the business, that tax is almost certainly going to end up being used as working capital in the period between collecting it and having to pay it over. Certainly, that's what people do with VAT here in the UK. So yeah, it would be quite nerve-wracking that you could find your own house on the line if your employer hasn't met its tax liabilities.
Correct.
So do people insure against that to persuade their accountants or whoever to take on the responsibility of being the regulated person, or is it do they actually put in place particular trust arrangements? How do people get comfortable with that risk?
Usually it's about to ensure that whatever is collected is remitted. So just whatever your monthly reconciliation, the frequency of how an entity remits tax usually is based on the prior quarter, the prior year, whatever their sales tax was, and the state will determine that filing frequency. So on a monthly basis, which is a common filing frequency, a business will go through the process, make their sales, collect their taxes at the time of sale, and then at the end of the month, remit that tax. And so that just basically keeps up with what's happening, and then some sort of reconciliation is done at the end of the month to be sure that all sales tax that was collected was effectively remitted. So it's just an internal function of good business practice, and then understanding the ramifications if you don't do that.
Yeah. And in terms of what the tax point is for that, so say it was me and I was issuing an invoice for some legal work that I've done. In the UK, we would typically give clients kind of 28 days to pay, even though our invoices say they're payable on delivery, before we start chasing them. But we only account for VAT quarterly, so normally that's not too much of an issue. But would it be the same in the US? So you issue your invoice, that's the tax point, and if the client hasn't paid by the end of the month, which is probably more likely, then you need to cash flow the state sales tax payment from your working capital.
Correct. That's exactly right.
Okay, so I imagine people are quite hot on getting their invoices paid more quickly than perhaps we sometimes are.
Correct. Correct.
A lot of services are not subject to sales tax, though. Only in certain states will they impose a sales tax. So as CPAs, we don't necessarily have to worry about that so much.
Right. Services are not. However, certain states, to Michael's point, do, such as Texas, they're very aggressive when it comes to services. So even an accounting service or a bookkeeping service in Texas can deem to be a data processing service. The use of computer is used to process, such as like QuickBooks, to manipulate client data or enter client data, is considered a taxable service in Texas. So it varies. Each state is very different when it comes to services. Usually states that do not impose a corporate income tax and who rely heavily on their sales tax revenue are states that are very aggressive in their structure of sales tax and what's taxable. And they usually kind of try to cast a wide net over items, taxable property and taxable services. South Dakota and Washington are two good examples of that.
Again, really interesting thing to factor in when you're thinking about your location, because perhaps, I mean, again, from a European perspective, we probably just look at the kind of headline corporation tax rates or corporate income tax rates and not think about actually what are we going to be having to pay instead, because state governments, like every piece of government, always want their money. So if they aren't getting it one way, they will try and get it another, and it may end up actually being more trouble to deal with the more onerous sales tax regime when you're trying to get everything else done than pay a bit more corporation tax, but have to worry about it once a year.
Exactly. That's exactly right, John. And a lot of times, for a state that doesn't have an income tax regime, their sales tax rates are also very high. So they're usually in the 8, 9, 10% range. So they really are trying to meet that revenue from the sales and use tax perspective that they're not getting any other ways. That's very interesting. And from an employee perspective, Michael, you mentioned employees moving around before, which was quite an interesting one. Something post-COVID people looked at in the UK was, can I go and live in Spain or Italy for a couple of months over the summer, and I'll work during the day, hang out by the pool at night, and maybe take my couple of weeks summer holiday in the middle, which sadly turned out to be not possible, because you would end up subject to local employment law and social security and all of those kind of obligations if you're there for too long.
Do you have similar issues in the US if you have employees who decide to take themselves off to, I don't know, Aspen skiing for the winter? Um,
Absolutely. During COVID, there was a big push to move away from big cities, right, and lower the cost of living. Uh, in my own small practice at the time, I had 3 or 4 people from our office that had gone off to live at a lake somewhere, or you know, an entirely different state. And that can trigger nexus for a company depending on what that employee is doing. If they are producing income and adding value to the company in another state, that's likely going to trigger state nexus for their employer. So that's a conversation that really has to be had ahead of time before the employee decides to move, so that everybody's on the same page, and both the employer and the employee know what they're getting into.
and when they're looking at that, what kind of state taxes are there on employees, and similar kind of government obligations that people might have to meet?
Yeah, depending on the state, they may be subject to a state income tax withholding requirement. So where I am located, in Georgia, it's a 6% tax that my employer has to withhold and remit over to the state of Georgia. And because I live in Georgia and I make money for the company, our company is now subject to a Georgia state income tax, which is also the corporate tax is also 6%. So, but if Jamie is in North Carolina, the facts are different. It's different tax rates, but the company's still liable for withholding on her salary and paying that withholding tax over to the North Carolina Department of Revenue.
That's
And
exactly right.
presumably
Yeah.
So
Go ahead,
presumably the
Sarah.
states also have different social security obligations, which you would need to comply with.
Exactly. So besides the corporate tax, there's also like unemployment insurance taxes that states are that employers are required to withhold and remit as well. And that also varies, but it usually applies to even states that do not impose an individual income tax. So if an individual is in a state that doesn't have an individual income tax, like Florida, they're still subject to an unemployment or reemployment insurance tax. So there's still a component of tax that's still required, even if there's not an income tax withholding component.
And is that typically if somebody is working in a state for 30 days, 90 days? Obviously, it will vary, but what kind of level of exposure does an individual have to have before you need to start thinking, this employee's been in Nevada for X amount of time, so we need to start worrying about tax in that jurisdiction?
Each state has their own criteria. Some states say 15 days, some states say 3 days, some states say 1 day. Some states do allow for 30 days. After COVID, there was a push to give more of a longer period, but I think for the most part, that hasn't really been welcomed for all states. So it just depends. It really does.
Well, so those are really very short periods. I mean, the idea of it being a day or 3 days, you could go on a business trip to see a client or attend one of the conferences that we go to, and find yourself subject to state tax as a result.
It also depend on what activities you're doing in the state,
Yeah.
and whether or not you're performing services or accepting orders or things like that, like what activities are being conducted.
Yeah. Okay, but definitely something that businesses will need to understand, particularly if they're relatively new to the US and they have a relatively small staff base who are moving around, trying to build relationships and keep the business operating from their laptop and their mobile at the same time. They could
Mhm.
find themselves in a pickle quite quickly, I imagine.
Yeah, it's really best practice to invest in policies, processes, and software that are going to track that kind of thing from an early stage. Because if you get to where you have employees kind of all over the United States and you haven't addressed this yet, it can be a big mess to contend with.
Yes.
So there are timekeeping softwares out there for professional
Mhm.
services companies like ours that every time you enter your time for the day, you say which state you're in, and that makes it very easy to track. Engineering firms have to do that, architecture firms. If you're selling goods, Jamie talked about protections under Public Law 86272 earlier. The salespeople might not trigger additional requirements for you, right? Because they're selling, and then the orders are coming back to the home office in a different state. So yeah, it's just prudent to look at this early on when you're in one or two states before you get spread out throughout the entire United States, to kind of put policies in place to tame this beast that is state and local tax.
For sure. And services is really a big issue for states and employees traveling. So as far as what's being done, what services are being done and when and for how long. So that's usually the big trigger for Nexus and employees.
Really interesting. So I guess from conversations we've had before, I was a little bit aware that these issues could arise, but they obviously arise at a very early stage. And it's really crucial for people who are thinking about establishing that business in the US and trading widely, which I'm sure most people want to do, rather than just focusing on an individual state or locality. As their business develops, they should make sure that they've got the right policies in place, the right software in place, and the right advisors in place, being you, Jamie, and Michael, to make sure that they're actually complying and don't find themselves with a nightmare of remediation, litigation, fines, interest, back tax, and just the pain of dealing with all of that stuff by getting over enthusiastic and starting to trade and have employees all over the place without thinking through the implications of what they're doing. Great. Well, look, thank you very much, Jamie and Michael, for joining me again. It was great to talk to you, and I look forward to our next podcast, which I'm sure will be even more useful than this one was. Thanks again.
Thank you.
Thanks, John.